Welcome to Illuminati Silver. We tell you the truth about silver. Today is Tuesday the 7th of July 2020, and yesterday we produced a video entitled Gold and Silver Prices Rise Alongside Equities, where we highlighted that a strong equity market across the globe yesterday did not stop gold and silver prices also rising, especially as we saw some weakness in the US dollar. Now, on the weekend, we published our Gold and Silver Weekly Update, where we highlighted that we should expect to see gold push towards that 1800 level, and silver would operate towards the top end of our trading range of 1750 to 1850, without completely ruling out a potential spike towards $19, but the earlier range was more likely. Well, at the time of producing this podcast, we can see that silver is currently trading at $18.32, some 18 cents higher than Friday's close. But gold is just $5 off 1800, standing at $1,795, some $17 higher than Friday's close. And this is despite an ever so slight strengthening of the US dollar today. Now, that said, equity markets are down on average across the board between 0.5% and 1%, but that is after a strong rally yesterday. What is interesting to us for the moment, though, is gold, which we are confident will surpass the 1800 mark this week, but the question is, of course, will it hold? Now, in recent videos, we've made quite large of the fact that what was underpinning our precious metal markets of late has not necessarily been the physical buying of gold by investors per se, but by the paper markets, including ETFs and COMEX, but which have some underlying gold holding or acquisition facility. We've made much of this as when prices were falling, it's all been the result of manipulation, the pumpers cry. And now they're rising, the manipulation accusations seem to have disappeared. That said, the purpose of today's video is not really to go down that particular rabbit hole, but to emphasize that since the COVID-19 crisis hit, we have seen a significant fall in the acquisition of gold by Asia and an increasing acquisition of gold, even if mainly through ETFs and futures and what we describe as the paper markets, by the West. Yesterday, a fascinating article was published by Bloomberg, putting this into context and suggesting towards the end something we who hold gold and silver could actually become excited about. So let's take a look. Bloomberg Article dated July 5th, 2020. Headline: Gold funds underpin pandemic price rally as jewelers vanish. Western investors piling into gold in the pandemic are more than making up for a collapse in demand for physical metal from traditional retail buyers in China and India, helping push prices to an 8-year high. Inflows into exchange-traded funds this year, mostly in North America and Europe, are already inches away from the annual record set in 2009, according to data compiled by Bloomberg. Meanwhile, demand in China and India, the world's two biggest buyers of gold bars, coins and jewellery, plunged after the coronavirus stalled imports and emptied malls. Sales have been slow to return as rising prices deter buyers. The shift underscores the global push and pull for gold between Western investors looking for a safe haven and traditional demand centres for physical gold in Asia. It also raises crucial questions for the market this year, as gold prices risk losing support if ETF inflows slow down, or could gain even more momentum if Chinese and Indian demand bounces back. We expect the US and European investors to remain interested in gold regardless of Asian demand, said Dawai Kung, head of commodities and portfolio manager at DWS Investment Managers Americas Inc. If the buying pattern were to go up as well for China and India at the same time as what you see in the ETF market, then the price would have come up even further. Fear-driven investment demand in developed countries have contributed about 18% to this year's gains in gold prices, while weaker buying by emerging market consumers provided an 8% drag, Goldman Sachs Group Inc. estimated in a June note. An economic recovery and a weaker dollar may mean emerging market demand in the second half of the year could shift from being a drag on gold prices to a tailwind. Still, higher gold prices could exacerbate demand destruction in the East and make prices even more dependent on investors in the West, said Commerzbank AG analyst Carsten Fritsch. Spot gold has risen 17% in 2020, closing out the second quarter with the largest rally in more than 4 years. On Tuesday, gold futures on the COMEX topped $1,800 an ounce for the first time since 2011. The higher prices have had a chilling effect on Asian shoppers, even as economies reopen. Traditionally seen as a store of wealth, demand for jewelry in China and India tumbled as lockdowns, job losses, and weak economic growth curbed discretionary spending. Precious metals consultancy Metals Focus Limited forecasts a 23% decline for Chinese gold jewelry consumption in 2020, while Indian demand is expected to drop 36%. Chinese gold sales could be as much as 30% lower than 2019, said China Gold Association Chief Executive Officer Zhang Yongtao. Still, that is an improvement from a previous estimate of a 50% decline when the outbreak was at its peak, he said. Nidhi Saxena, 31, a software engineer at a technology firm based in Gurugram, India, was planning to buy gold bangles in March, but changed her mind as gold prices soared and colleagues were laid off. I can't even think of buying gold right now when I'm not even sure if my job is safe, she said. Trade flows have also been affected. In India, which imports almost all the gold it consumes, imports dropped by about 99% in April and May. By contrast, demand from ETFs has surged as worries over the economic outlook, negative real rates, and currency debasement after massive global stimulus measures drove haven-seeking investors into gold. Total holdings of physical gold in ETFs have risen by more than 600 tons this year, according to data compiled by Bloomberg, and ETF inflows surpassed retail purchases in China and India in the first quarter for the first time since 2009. While consumer data isn't available yet for the second quarter, ETF buying increased during the 3 months to June. The demand for gold in 2020 has been almost exclusively supported by investment demand, said Steve Dunn, head of ETFs at Aberdeen Standard Investments. Flows are charging ahead at an unprecedented pace. Still, ETF buying only represents one part of this year's dramatic flows of bullion from east to west, a reversal from the typical direction in more normal times. More than 700 metric tons of gold have been added to vaults around New York this year, the most in records going back to 1993. The massive imports into the US were due in part to a scramble for gold among New York traders after the market was upended as virus lockdowns grounded planes and closed refineries. COMEX inventories have since surged to a record. It's not the first time investment demand for gold has surged during a period of global uncertainty, boosting prices and deterring Asian shoppers. Yet it's unclear what role a lingering coronavirus concerns may play. During the global financial crisis, consumer buying in China and India rebounded from lows within a year, but it took until 2013 and a slump in prices for combined demand in the region to hit the highest in a decade. Definitely we see that this year the retail business will be quite challenging, especially for the jewelry sector, said Roland Wang, Managing Director for China at the World Gold Council. A rebound in demand will depend on the economic and pandemic situation, he said. Yes, very interesting, especially should China and India demand for gold rise in the near future. That would certainly boost its price even from current high levels. Of course, if that should not happen and equity markets regain a foothold, then that position could change. But frankly, we repeat what we've stated on the weekend and for some considerable time. We have exciting times ahead for gold and silver, and we are expecting a small but continued firming and increasing of prices throughout the next few years, especially as currency values are undermined and equity markets so close to all-time highs. Something has to give. Now, it may not be tomorrow, but the environment is such that this most certainly will be the decade for precious metal prices. What do you think? Do share your thoughts. Thank you so much for listening, and if you haven't already done so, please subscribe to our channel, not forgetting to press the bell sign so that you're notified of our videos as and when they are published. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management, and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.